In this video, we're going to talk a little bit more about bonds, add a couple uh, peculiarities, if you will, to the bond market themselves. The first thing we'll talk a little bit about is bond ratings. All bonds are rated. They are graded by companies. Moody's, Standard & Poor's are two of those. Essentially, what they're looking at in grading is default risk. They do a financial analysis of a company, and they associate certain statistics to chance of default. And of course, the high grade bonds that are listed here are those bonds that have the least amount of risk. If you have the least amount of risk, you should be paying the lowest yield, which means you should have the highest price. So the highest priced bonds are going to be those bonds that are high grade bonds. And as you move down the system, as you move down through the grades, you get to more and more risky, which means you get to lower and lower prices. There are two kinds of returns that we want to talk about. The first being yield to call, and then realized yield to maturity. Yield to call is basically the refinancing function of the corporation. Companies want to refinance when interest rates fall far enough, and technically this is referred to as refunding. And in the bond contract, it talks about the yield premium, which is the price that must be paid in order for the company to refinance and buy back its debt. The yield premium typically is the principal plus something. Usually it's plus 1 year's coupon. So we have this yield to call that allows corporations to refinance their debt if interest falls far enough. Realized yield to maturity is really an investment strategy. It talks about setting a guideline, setting an investment horizon, if you will, so that let's say in 10 years you need $1 million. So you want to buy a bond or a bond portfolio that would provide that cash flow at the end of that 10 years. So to understand what rate of return we would earn, we need to predict a price at the end of the horizon. What this assumes, or what this requires then, is for us to predict future interest rates. And that's another class, another time. So let's talk about how this ultimately works. So for the call premium, in this case, we have a bond that has a 9% coupon and has $1,000 as the call premium. And in 5 years, the company can call this debt. So for the next 5 years, they can't do anything. They're stuck with what they have. When we look at the yield to call, then we see that the yield to call for this particular bond is 13.24%. The yield to maturity, if they hold it clear to maturity, is 10.1. I think you recognize that 13 is better than 10. And of course, we would hope that interest rates could fall far enough so that this bond would be called so that we could enjoy that 13.24%. Now, the realized yield to maturity just says, look, we're going to hold this bond just for 10 years. We need to predict what price it's going to be in 10 years. So we did that. You do that using the bond valuation worksheet, just like everything else. We'll figure out what the future price would be. In this case, you'd only have, in 10 years, you'd only have 10 years remaining. But let's just say we assume the required return is going to be 8%. Figure out the price, plug that in here. So in this case, the realized yield to maturity is 11.3%. So we basically have 3 different yields that we can talk about with respect to investing. If we hold to maturity, we'll earn 10%, 10.1. If we just hold it for 10 years, 11.3%. So obviously we would like to hold this for 11.3. We would, if this was our investment strategy, we would never hold it more than that 10 years. But if interest rates do fall far enough, we could enjoy a rate of return on the yield if they call the debt. So in general, what do we know about bond markets? They are typically over the counter. They're electronically transacted. There's a lot of bond issues, but unlike stocks, we typically don't trade bonds in hundreds or thousands of bonds at a time. They're typically done in much smaller numbers. Pricing for bonds can sometimes be difficult. That's just because of the lack of liquidity relative to speaking of particular common stocks themselves. So if you think about transactions, or Treasury quotations, right? So let's think about what we get from publications, right? So the first thing here is the date. This is when the bond is going to mature, May 15th, 2026. 1.75, this is the coupon rate. So if you multiply the coupon rate times 1,000, we would end up and figure out exactly 1.75% of 1,000 is $17.50. That is the coupon that we would be paid annually. Of course, we might have to divide that by 2 if it's semi-annual payments. The current bid price, 97.195. Now, there's the bid and the ask price. If you notice, the bid price is always less than the ask price. So what do these two prices mean for us? The two prices represent, the bid price is what you would sell this for. If you wanted to sell your bonds, you're going to sell it back through a broker, you would be able to receive $97 and roughly 20 cents. If you wanted to buy this, you would pay 97.21. So the difference in prices between these two, the ask price, right? That's this price. That is the price you pay to buy. That's the retail price. It's always high. This is the wholesale price, which obviously is always going to be lower. 0.3438, that's the change in price from the previous day. It's obviously up 34 cents. And the yield, based on the ask price, is 2.113%. So again, we get lots of information from the newspaper. Next, what price do you actually pay for a bond? Well, the clean price is the quoted price. That's the price that we just talked about. That is the ask price. Now, the dirty price is the price you actually pay. That's the quoted price plus accrued interest. So if you think about it, when you buy a bond, every day you own the bond, you earn interest. So a bond pays a coupon on Sunday, and now it's Friday, and you decide Friday, I want to sell this bond. Well, you've had it for 5 days past the last payment. So you earned 5 days worth of interest. So how we calculate this is you take the number of days since the last coupon, divide that in the number of days in the coupon period. Now this is either going to be 181 or 365. And then you calculate the interest, right? So it's half of the interest of the coupon times the principal. So this is $2.95. So from that previous slide, $972.11 is the clean price. The dirty price, you have to add the accrued interest. So you'd actually pay $975.06 to actually purchase this bond. And the last thing to kind of talk a little bit about is inflation, right? So we understand inflation has an impact on long-term investments. So inflation, by definition, has an impact on bonds. It also has an impact on items where the cash flows don't change. So since coupons are fixed, inflation has a double whammy, if you will, on bonds and fixed income instruments because they're long-term and because the coupon doesn't change. So the nominal rate is the annual rate. The real rate is what we refer to as your change in purchasing power. That's what you actually earn at the end of a time frame, assuming inflation is taken care of. So how we calculate the return, 1 plus R, this is the nominal rate. This is what's referred to as the Fisher effect. So 1 plus the real rate plus 1 plus inflation. Again, we can also do an approximation, and the approximation works pretty well, but the actual theoretical, the correct answer is all going to be determined using the time value here with inflation. So let's look quickly how this might play out, right? So if you require a 10% rate of return, a real return, and you expect inflation to be 8%, what's the nominal rate? Well, we have a Fisher effect worksheet. If you plug the numbers here, right, on the right here, the real rate's 10, the inflation rate's 8. So the Fisher effect, which is used for Treasury securities, it's the theoretically correct one, is 18.8%. Now, of course, you can do the approximation, which is just 10 plus 8, 18%. We can also do some other things where we can unwind things, right? So if you know the nominal rate's 10.25, somebody tells you what inflation is, you can calculate the real rates of return. And of course, the Treasury, the Fisher effect and the approximation will be different. They'll frequently be pretty close. They're not going to be dramatically different, but they are different enough that the approximation might not always give us a real good picture, if you will, of the actual impact of inflation or of the nominal rate. Now, how companies can deal with inflation, or how investors can deal with inflation, is to try to get rid of it, right? We need to try to eliminate the impact of inflation. So most government bonds, in fact, most corporate bonds, are all going to face inflation risk. Now, the government has created something called TIPS. They are an inflation-protected security. So essentially what happens with a TIP is that it offsets the influence of inflation. How does it do that? The principal for a typical bond is always $1,000 and it never changes. But in a TIP, the principal changes with inflation. So if, again, the principal is $1,000, if inflation is 2%, at the end of the year, the principal is going to go from 1,000 to 1,020. Add the 2%. When you change the principal, you also change the interest coupon payment. So how this tip works is it offsets inflation by adjusting principal and adjusting the coupon that's paid. Now, let's think about returns, though. A normal United States government bond, right? Essentially, we assume that it is risk-free, right? It has the lowest risk of the bond categories, if you will. So it also has the highest prices. But what about a tip? A tip, it's a benefit. It's something that's good for you. So if you wanted to buy a tip, let's say that the government bond, a 30-year Treasury bond was 3%. A 30-year tip might be 1.9%. It's going to be lower. Why is it going to be lower? Because there's no such thing as a free lunch. If you're getting a benefit, which is you're adjusting for inflation, you have to pay for that. And how you pay for that is by giving up yield. So that's the end of our discussion of bonds. Look forward to talking to you soon.